Hello everyone and welcome back. My name is Greg Furman and this is the Forex Weekly Outlook for the week of February the 11th, 2019. Now, to get started this week, we're going to begin where we always do with that all-important US dollar index. Now, the dollar coming off support down around the 90, basically about the 94.90 area. We've rallied up here, but as you can see, the indicators from VantagePoint are starting to show an overbought condition. Now, just because something's overbought doesn't mean it can't continue to move higher, but the dollar has even more problems ahead with this significant verified resistance zone up here as identified in the VantagePoint software. Now, again, when we're looking at these indicators here, the further the market moves off the critical long-term pivot, the T-cross long 95.78, the more likely it is we're going to return to that area. Now, much like in last week's Outlook, I had stated that the dollar is usually strong in the first week of the new month. That's come to fruition this past week, but that doesn't mean this is going to continue. So once again, in most cases, you can see that when the dollar rallies, it's usually very, very short term until we get a significant pullback. We can identify this very easily by looking at the charts here. So again, the probability that the dollar starts to run into a bit of trouble by midweek next week is very, very strong. Now, the one thing I will point out here is that the equity markets, again, the dollar and stocks have, for the most part, have been kind of going up and down together this year. But this past week in the VantagePoint live training room on Wednesday, I identified this top and said that unless we can move past this particular area on stocks, they are not going to go higher. And of course, that too has come to fruition here. But there's a lot of factors that go into this failure in the stock market this past week. Basically, the stocks have been moving up, consistently moving higher for the month of January. The S&P 500 has moved up some 10-11%. So when we look at this, a 10% move is clearly far too much, and I attribute 8% of that certainly not on earnings or growth forecasts, but based around the Fed. So the Fed is talking about pulling out of the market, no more rate hikes. So stocks largely got their boost from that, not from real demand. So not surprisingly, as I've talked about over the last, basically in the month of January, that we really do have to break above 28.45 to confirm any kind of long-term rally. But more importantly, we really need to break above this critical, again, 28.21 is a critical level, but an additional triple top sitting at 29.48. I don't anticipate that being retested anytime in the near future. Again, looking at those global growth forecasts, the fact that we've made a 10% move up in January, this failure was pretty easy for me to call on Wednesday morning. Sure enough, we've come lower. However, stocks have failed to break through and hold below our T-cross long. That pivot area is 26.72. So for next week, we're looking to play a range between essentially the 27.37, 27.38 area and this critical VP level of 26.72. A break of either side of that will see stocks move higher. Now, oil is basically getting a little bit of a boost on Friday, but nothing significant. Still under pressure here. We're closing 53.09. The T-cross long pivot area here is 53.24. And just because I do get a lot of interest in stocks or questions about stocks, one of the ways we also look at this too is not just the T-cross long on the S&P 500, but the long predicted 27.09. We're closing below that area. Essentially, this is more or less the second day in a row. Now, usually in this type of signal, when I've talked about, again, in the VP Live seminars, our next seminar is going to be in March, just to refresh everybody. If anybody wants to have a look at that or come down and do some one-on-one training with me down at that seminar, you can go to vpseminar.com and have a look at that. So usually when I see a signal of closing 2 days below our long prediction predicted, in most cases, that is a trigger for a bigger move in that particular direction, whether that be up or down. We can see the same signal back here. So 2709 is a rather big area here to begin the week on Monday and Tuesday. Now, again, with oil kind of basically showing weakness and potentially a longer term short signal here, that again goes to the argument that stocks could be getting ready to break lower. So we certainly want to keep an eye on that. And again, one of my favorite intermarket correlations, of course, is gold. Gold is refusing. 3 days in a row, we're coming down, banging off this T-cross long, 1309. Once again, in the VantagePoint live training room on Monday and Tuesday of this past week, I encouraged longs on gold. My position on gold has not changed at this particular time. Looking at global growth forecasts, political uncertainty would be an understatement at this particular point. I'm not really seeing a trade deal coming out of China on the March deadline, and the likelihood of another government shutdown very, very high. All of this supports gold and does not support equities. So we must take basic fundamentals into our advanced intermarket technical analysis. So when we look at all of these things and we start bringing this together, the first pair in the Forex, the most heavily traded pair, is the Euro-US. Now, if gold continues to advance, equities slide a little bit, dollar index, we can see that extreme overbought condition in the dollar index, then the likelihood of the euro reversing higher off these verified support zones starting at 112.89, but that area would extend all the way down into the 112.15 area. This is a classic buy zone here, guys. So we're just waiting for those additional markets to turn. We can see the euro already in an oversold condition. The probability of a retracement very, very high back towards the 113.97. But once again, when we look at our long predicted, this is the area we need to start to watch the week, 113.70, to see if we can push back up above this area to take the pressure off the downside. Now, as we look at the Euro-US counterpart, the US Swiss Franc, we can see here that we've got a significant resistance starting to form right here off of this particular level. This is just one of many resistance zones on this pair. When we look at this area right now, it's 1.0022 on the upside. So, but we've got such strong resistance. When we look at the equity markets over the last 7 or 8 years, the very best the US Swiss franc has done, I think, is around the 103 area. But realistically, over the last year, we've been unable to break above 101.28. So selling into 101.28, clearly the preferred strategy here. And again, that's based on the intermarket correlations. This US Swiss franc also can be a leading indicator for stocks. If it doesn't start moving and break higher, that's yet another warning sign that stocks could be getting ready for a bigger pullback. Now, once again, our T-cross, our key pivot area is 99.54. I do anticipate a retest of that area, but a more significant level right now on an intraday basis. You can see how the market's been hugging the VantagePoint predicted moving average, and now we're getting a little toppy. So a breakdown below 99.97 should see the downside accelerate back into this lower 99 level, or potentially lower if we get a significant sell-off in stocks. Now, with the pound dollar next week, still no real sign of a buy signal here on this particular pair, but Brexit is obviously causing this pair, the British pound, a lot of problems. So right now, I'll tell you guys what I tell my own direct clients. Tend to stay away from this particular pair right now. There's too much noise surrounding it. Big swings in the market. Brexit's on, Brexit's off. So we tend to be very cautious, but the primary signal with VantagePoint has been down. Once again, if the US dollar comes under pressure, this is a great potential spot to look for longs again off this, but the verified zone is still a little bit lower, down around 128.30. So watch that area very closely for a potential bounce. But if we lose that area right here, again, we've got 128.30. Then if we lose that area, that's likely going to take us down into the 126.76 area. But ultimately here, we are looking for longs. We're just waiting for that signal to confirm a reversal. Now, with the dollar yen last week, which is kind of funny here, guys, we start the new week exactly where we started 1 week ago. There is nothing pretty about this particular pair right now, but it is, or it has been, a moneymaker. I've been very steadfast on my position that we need a clean break of 110.16 and blow through this area, close above 110 at least 2 or 3 days in a row. Then we can start really going on longs. But for this previous week and even right now, the only thing really holding this pair up is the T-cross long, our long-term pivot at 109.55. Very weak close at 109.74. Very little has changed on this particular pair, but a big move up or a big move down on the S&P 500 will be the trigger that tells this pair to break higher or lower, excuse me. So if the S&P breaks higher and stocks hold, we get a risk on environment, everything's good again next week, then dollar yen goes higher. But if stocks plummet, then dollar yen is going to blow through 109.55, guys, like nothing, in a heartbeat, in a blink of an eye. So watch your stocks very closely. Right now, it's mildly bearish, but when we look at our long-term pivot area, we can see that the market is hugging it. So every single day we've got a long off the VantagePoint predicted moving average, but indisputably we also have a short just below 110.16. So there's a two-way trade going on here, and when it breaks, it will be significant. So watch for that break and keep a close eye. If gold goes higher, dollar yen goes lower. Stocks go lower, dollar yen goes lower. That's the trade here, guys. Now, as we come into the US-Canadian pair for next week, we've recovered, back to the upside, then sold off on that Canadian jobs report. In my respectful opinion, the jobs number out of Canada was extremely skewed. 67,000 new jobs when we were only supposed to get 8,000. The only problem is the unemployment rate has ticked higher, not lower. Not really supporting that strong jobs market. Finally, a little bit of wage growth in Canada, but minimal. So once again, US-Canada is going to get dragged around by the stock market. S&P 500 goes lower, US-Canada goes higher, and vice versa. But right now, when I look at this, and this is why one of my favorite strategies is to watch the VantagePoint long predicted. After a big move up the last couple of days, the jobs report hammered this pair lower, but it failed exactly on the long predicted at 132.23. So this is the level we want to watch to begin the week. If we can hold above this level, longs are still good. If we break down below this level, then and close below this level for 2 days in a row, then shorts are back in play. But that's going to take oil moving higher and the S&P moving higher for that to happen, and that's highly debatable at this particular time. Now, with Aussie US and New Zealand US still moving lower, but again, 100% dependent if the stocks can hold that critical VP level around the 2700 mark. If we can hold at 2700 mark, move higher up on stocks, Aussie US and New Zealand US will both violently turn around. So we want to watch these levels down here very, very closely to see if we can, hold above these lows down around 70.50. I would watch that area very closely. We can see that Aussie is in an oversold condition. Our predicted RSI is very slowly starting to roll back up. That doesn't mean we're going higher. It's going to take stocks, specifically the S&P 500, to turn higher, to send Aussie higher and to send New Zealand higher. But you can see that both pairs are coming into significant support. The Aussie, very significant support down here around the 67 mark. You can see coming off this swing low, a verified zone. If we can hold this level, stocks can move higher, then Aussie US and New Zealand US will follow. US CAD will move lower. That's how we play these very, very volatile basically commodity currencies, but everybody calls them commodity currencies. I'm beginning to call them stock equity currencies because they're being driven around by the S&P 500 more than they are by most of your commodities. So with that said, this is the Forex Weekly Outlook for the week of February the 11th, 2019.